Hello, and welcome to this special CBTV interview with Lynn B. Thurgood, president of Oxford Wealth Advisors in Rio Rancho, New Mexico. Lynn B. is a chartered life underwriter and one of New Mexico's only certified annuity specialists, who since 1987 has specialized in working with retirees and pre-retirees. In addition, he is the president of Central New Mexico's Society of Financial Awareness, also known as SOFA. Lynn B., once more, welcome back to Checks and Balances TV.
Thanks, Matt. Good to see you again.
We've had a couple of really good interviews. I'm sure the people in Rio Rancho and the surrounding areas have really enjoyed some of the knowledge and expertise that you've related, and I want to give them a little bit more today.
Okay, let's get started.
You ready?
I'm ready.
All right, good. I want to first of all talk about a very wise and prudent investment rule that most advisors are very well aware of, but many consumers are not, and Americans are not, and that's the investment rule of 100. So help our viewers to understand, what does this rule mean, and how do you help your clients achieve this golden rule of the investment rule of 100?
Well, Matt, the rule of 100 is a very simple formula that we use to help people determine what percentage of their assets potentially should have a risk exposure to them, and what percentage should be in what we call safe and secure positions. In New Mexico, we like to use the terminology red or green. Green is safe and secure, red is risk. Of course, we're the chili capital, and so red or green is always a great question. But the formula works very simply like this. You take your age and you subtract it from 100. Now lately we've even seen some planning discussions about perhaps reducing that age or that formula to the rule of 80 instead of the rule of 100. But whatever formula you want to use, subtract your age from that 80 or that 100, and that remainder, that result, is the maximum exposure that we suggest folks should have in the red category, or assets at risk, meaning that their age or that modified amount using the rule of 80 should be in a safe and secure position.
Okay, so rule of 100, subtract your age. So if you're 65, you've got 35 left.
Right.
So your age represents, as you said, how much of your money, your nest egg, should be in safe, guaranteed accounts.
Right. And
the balance in this example being 35% could be left at risk in the market. Is that
it
accurate?
Could be. And of course we know that in visiting with people, there's a lot of folks that don't belong one penny in the market. The market's down a few points, they can't sleep at night, then what are they doing in there? So that's a general rule, though. It's a good place to get started, and then depending on the risk tolerance and of the spouses and so on and so forth, and the goals, it's a good rule to start from.
I guess a real good question to ask your potential clients is, how much of your money do you want to keep at risk? Or can you afford to lose?
That's exactly right. And of course, when that question is asked, generally they say, well, we don't want to lose anything. And that's consistent with our message that we are continuing to put out to everybody we see. The most important thing in this market right now, in this economy, is don't lose. Don't lose. We may not earn as much as we could elsewhere, but we just can't afford to be losing at this stage in life.
Yeah. All right, well, let's say that we have someone who says, well, I have done well in the market in the past, I still want to have some market exposure. For those people that want a segment of their nest egg in the market, what are some good options for clients to consider on the risk side or risk portion of their portfolio? Well,
certainly there's over, goodness, 2,000 or more, 20,000. Mutual funds out there in all different shapes and flavors and sizes. We can help people to determine within that huge arena of options what funds might be the best performers, and we can help them digest the prospectuses and everything else that come with them. No-load funds are a great option for some people. It just depends again on what their goals are. Because you can be overrun by the stuff that they'll see on TV or they'll read in magazines with certain companies that love to promote themselves and have earned quite a lot of money over the years because of their name. And we find when we do comparison between them and other options out there that those funds that they thought were just the best thing since sliced bread are terrible performers, but they don't know any better because they bought the name.
Yeah. Yeah, good point. Some firms and I won't mention the names, but some brokerage firms have proprietary products that they create, and in most cases they're mutual funds. Yeah. But what most consumers don't know is there's a lot higher commissions or fees in those versus the other 19,999 mutual funds out there.
Yeah, and you know, a lot of these brokers have quotas. They have basically pressures and mandates on them that they need to do a certain percentage in these areas or they're going to let them go. It's the bottom line of overhead and expenses and profitability for the company, and if you're not independent, you're beholden to those philosophies, and there's a little bit of a conflict there as it relates to, are you working for the client or are you trying to just keep your job?
Yeah, yeah. All right, so somebody who wants to have a certain portion of their money at risk in the market, you can help them to do it with an eye towards lower fees and perhaps lower taxes as well.
That's the goal.
All right, let's flip the coin now, and for those individuals that say, this is the chunk of my nest egg I want safe and sound, what are some good options for your clients to consider on the safe money side?
Well, on the safe money side, certainly we look at annuities, fixed index annuities and fixed annuities, deferred annuities as safe and secure, where they have guarantee of principal, and most of those products have a guaranteed minimum growth rate attached to them. They have a 150-year history of safety, and those are important things nowadays, safety and guarantees. So it's important to understand those tools. Certainly the bank option is out there with the FDIC, but those returns nowadays are hard to get excited about. But in fairness to safe and secure positions, that is an option. And certainly a certain percentage of assets we encourage people to keep in a liquid reserve, cash reserve position. And so those banks and other types of things are available for that. But then we want to employ other things that will give us safety but growth.
Yeah. Thinking about certificates of deposits, I think that was the old name for them. Recently they're called certificates of disappointment.
Or depreciation.
Depreciation. When you figure out after taxes and inflation, you are losing buying power.
Yeah, unfortunately, that's the case. So folks, again, it's important to get educated about there are other options out there that are safe and yet can keep us ahead of inflationary exposure. Now,
you mentioned fixed annuities, which is generally a fixed interest rate, maybe guaranteed for a number of years, but you also mentioned fixed indexed annuities.
Right.
Kind of the best of both worlds as far as a variable annuity and a fixed annuity. Tell our viewers a little bit more about this safe option called a fixed indexed annuity.
Well, the fixed index annuities were created in the mid-90s, and they were designed to kind of fill the gap between, okay, if I want to put my money for safety, I got to go to a CD, or if I want to put my money for growth, I got to put it in the market. And so in the mid-90s, the insurance industry created this product called a fixed index annuity that allows folks to put their money into a fixed, safe position, but then internally they look at the interest crediting each year, link it for growth only. They just simply look at the market and see how it's done from one point to another point, usually an annual, what they call point-to-point tracking. And if the markets are up, you get a piece of that market activity credited to that account. You lock in your new number at that new level, and you start the next year there, and you continue to grow. In a positive market, you go in and lock, you grow and lock, you grow and lock, and it's just a ratchet or a stair type of a progression. On the other side of the coin, if the markets take a tumble, which that's happened a few times in the last decade, those assets, because of the locking feature, never go backwards. So you earn what you earn and you keep what you earn and build on it from there. You never go backwards, and that's a big deal nowadays.
So what you're saying in essence is if the market goes up, like the S&P 500 or Dow Jones goes up, they'll get a part, not all of the gain, but it's locked in. And if the market loses 20% the next year, they don't lose their principal nor their previous year's gains?
That's correct. Those are all locked in. That locking feature and the reset, as they call it, is a powerful tool to protect and continue to grow assets.
I'd imagine that many of your clients who hear about this kind of financial vehicle are interested in putting a portion of their money in something like this that gives them growth potential based on what the market does when it performs well, but the safety of knowing you can't lose anything when the bears show up.
Well, that provides a lot of peace of mind, because we're all worried about, gee, I don't want to get out of the market because I want to be there for the growth, but how do I know when to get in and when to get out? This takes away all that guesswork, because you're able to put your assets in a safe position, and you're in the game. If the markets are up, you're getting your piece of that up, and you're locking it in forever. And if the markets are down, you're safe.
Wow.
And that's a great tool.
That sounds wonderful. Excellent. I can see why you have so many clients throughout the Rio Rancho area and surrounding areas. Now, on our CBTV website, we have a segment called 21st Century Investing. We believe that investors should buy investment products wholesale, not retail, whenever possible. So how do you help your clients become, I guess, smarter or more savvy investors, and perhaps, invest wholesale and not always retail?
Well, it's certainly important in today's environment that folks work with an independent advisor. Matt, there's lots of advisors to choose from out there, and you have to understand what is the motivation and what are they really looking for in the way of that relationship with that client, that individual, to help them with their needs. And within the options that are available out there today, we have ETFs that act a lot like stocks, within the no loads and so on and so forth, that people can use, that are very tax efficient options. And within our practice, we have those tools available within our team. No load funds are certainly an option that people can look at, that can be an efficient tool in the investing for the future. There's variable annuities out there. We talked earlier about the hidden fees and the risk and everything with variable annuities, but there's actually some variable annuities out there that are no load and that have very, very low fees. But most people don't hear about those because those don't generate the commissions to the broker that the other products do. And again, we got to understand the difference between an independent advisor and a career advisor. A career guy or gal has quotas, has obligations to their system that they have to meet, or they get sent walking on the road for another job. Independent really is working for the client's best interest. That's what we do. The fiduciary standard versus just the suitability standard, and that's an interesting discussion as to, suitability means, gee, it was okay when we sold it to you, but down the road things change, that you're on your own. Fiduciary, that's the kind of thing that I would do for myself or for my mother or my father. There's a big difference between, well, it was suitable versus its suitability versus a fiduciary standard. So those are a couple of different things that we would use and employ for investing in the 21st century, as you will, to educate. It's all about education and having the full universe of options available to you and knowing which ones fit where for your best benefit.
Yep. Independent, that's the #1 rule. Every prospective client American should ask their advisor, are you truly independent, or are you beholden to the company you're working with?
That's right.
And then becoming a 21st century investor to have lower fees and lower taxes is extremely important. So you mentioned some ideas on mutual funds, variable annuities, ETFs. All of these are great possibilities, but I guess the bottom line is find somebody that's knowledgeable, somebody that you like, somebody that has your best interest at heart, and then buddy up and work with them. And it sounds like that's what the Oxford Group's all about.
That's the team that we've built, and that's the opportunity that we look for, is a family helping family and friends helping friends to achieve those goals, to bring us peace of mind, allow us to sleep well at night, and have those assets protected for us and for our heirs, our beneficiaries, the people we love.
Sounds good to me. Sign me up.
You're on.
All right, Lynn. Good to have you back at CBTV, and we'll look forward to the next round
of
interviews. For even more information about Lynn B. Thurgood and his financial services practice, Oxford Wealth Advisors, or the Central New Mexico's Society of Financial Awareness, contact him at 505-891-9800, or visit him on the web at www.oxfordwealthnm.com.